Question 8. How does the NEOS S&P 500 High-Dividend Index selection process work? The NEOS S&P 500 High-Dividend Index, which the SPYI ETF tracks, employs a specific selection process to choose its constituents, focusing on high-dividend paying companies within the S&P 500. Here's a breakdown of the key steps involved. 1. Universe definition. The starting point involves defining the investable universe. The index considers all companies within the S&P 500, a broad market index encompassing 500 of the largest publicly traded companies in the U.S. 2. Dividend yield filter. The index applies a minimum dividend yield filter. This initial screening eliminates companies that fall below a certain threshold in terms of their current dividend yield. This ensures a focus on companies with a history of paying out a significant portion of their earnings as dividends. 3. Liquidity and free float adjustment. The index considers liquidity and investability factors. Companies with low trading volume or limited shares available for public purchase might be excluded to ensure the index constituents are tradable and accessible. 4. Weighting methodology. Once the initial screening is complete, the remaining companies are weighted based on their adjusted dividend yield. This means companies with higher dividend yields receive a greater weighting within the index, further amplifying the focus on high-dividend pairs in the final composition. 5. Rebalancing. The index undergoes periodic rebalancing, typically quarterly, to reflect any changes in the S&P 500 or the characteristics of the constituent companies. This ensures the index composition remains aligned with its selection criteria and continues to represent the high-dividend segment of the S&P 500. Question 9. How does the SPYI ETF manage potential volatility in its high-dividend holdings? The SPYI ETF, while offering the potential for high dividends, inherently faces the challenge of managing volatility within its holdings due to its focus on high-dividend pairs. Here's how the ETF approaches this challenge. 1. Diversification within high-dividend segment. While not offering the same level of diversification as a broad market S&P 500 ETF, the SPYI ETF still provides diversification within the high-dividend segment of the S&P 500. This involves holding companies across various sectors and industries, mitigating the risk associated with relying solely on the performance of any single company. 2. Underlying company selection process. The NEOS S&P 500 High-Dividend Index, tracked by the SPYI ETF, employs a selection process that considers liquidity and investability factors. This helps ensure the index constituents are established companies with a relatively stable track record of paying dividends. While not guaranteeing immunity to volatility, it potentially reduces exposure to highly volatile, smaller companies with less established dividend histories. 3. Active management. Limited role. Unlike passively managed high-dividend ETFs, the SPYI ETF utilizes active management to some extent. However, it's crucial to understand that the active management primarily focuses on selecting high-dividend pairs from the S&P 500 and does not directly attempt to mitigate market volatility. 4. Accepting the inherent risks. By its very nature, focusing on high-dividend pairs often means investing in mature companies with potentially slower growth prospects compared to the broader market. These companies might exhibit higher dividend yields due to a larger portion of their earnings being distributed as dividends, but they might also be more susceptible to economic downturns that can impact their share prices. Therefore, it's important to acknowledge that the SPYI ETF does not actively manage volatility in the traditional sense. While the aforementioned factors might contribute to a certain level of inherent stability, the ETF remains exposed to market fluctuations and potential volatility associated with its focus on high dividend-paying companies. Question 10. How does the liquidity of the SPYI ETF compare to other SP 500 ETFs? The liquidity of the SPYI ETF, measured by its average daily trading volume (ADV), is generally lower compared to several widely traded SP 500 ETFs. Here's a breakdown for better understanding here. SPYI ETF. As of February 27, 2024, the SPYI ETF boasts an ADV of approximately $30 million. While not insignificant, it falls short of the trading volumes observed in many other SP 500 ETFs. Comparison with popular SP 500 ETFs. SPDR SP 500 ETF. SPY. This behemoth of the SP 500 ETF space enjoys an ADV exceeding $30 billion, dwarfing the SPYI ETF's liquidity by a significant margin. Vanguard SP 500 ETF, VOO. Another giant, VOO exhibits an ADV exceeding $20 billion, significantly outpacing the SPYI ETF in terms of liquidity. iShares Core SP 500 ETF, IVV. This widely held ETF also boasts an ADV exceeding $10 billion, showcasing its superior liquidity compared to the SPYI ETF. Implications of lower liquidity. Wider bid-ask spreads. The SPYI ETF's lower trading volume might translate to wider bid-ask spreads, potentially impacting investors when entering or exiting positions. The difference between the buying and selling price might be larger, potentially leading to slightly higher transaction costs. Potential difficulty entering, exiting large positions. Due to the lower volume, it might be more challenging to enter or exit very large positions in the SPYI ETF compared to highly liquid SP 500 ETFs. This could be particularly relevant for institutional investors or individuals managing large portfolios. However, it's important to note that the SPYI ETF still offers sufficient liquidity for most individual investors, especially those investing smaller amounts. The lower liquidity comes alongside the SPYI ETF's unique focus on high dividend pairs, which might be a trade-off acceptable to some investors seeking this specific investment strategy. Question 11. How does the SPYI ETF fit into different asset allocation strategies? The SPYI ETF can potentially fit into different asset allocation strategies, depending on your individual goals and risk tolerance. Here's how it might integrate into various approaches. Income-oriented strategies. Core income allocation. For investors seeking a reliable stream of income to supplement their other income sources, the SPYI ETF's high dividend yield can be a core component of their income-oriented portfolio allocation. It can provide regular income distributions while potentially offering some capital appreciation over the long term. Income diversification. Investors with existing income-generating assets like bonds might consider the SPYI ETF to diversify their income stream beyond traditional fixed income options. This can potentially help manage risk and offer exposure to potential capital appreciation alongside the dividends. Total return strategies. Satellite allocation. Within a broader total return strategy focused on long-term capital appreciation, the SPYI ETF can serve as a satellite allocation offering complementary benefits. While its focus on high-dividend pairs might lead to slightly lower long-term growth potential compared to the broader market, the dividends can contribute to the overall portfolio's total return. Strategic tactical allocation. Seasoned investors with a high risk tolerance might strategically use the SPYI ETF as a tactical allocation to potentially capitalize on periods when high dividend sectors outperform the broader market. However, this approach requires active management and carries significant risks. Considerations for integration. Risk tolerance. The SPYI ETF carries inherent risks associated with market volatility, sector concentration, and active management fees. It's crucial to ensure your risk tolerance aligns with the potential risks before integrating it into your portfolio. Investment horizon. The SPYI ETF might be more suitable for investors with a longer-term investment horizon who can potentially weather market fluctuations and benefit from potential long-term capital appreciation alongside the dividends. Overall portfolio diversification. The SPYI ETF should not be the sole component of your portfolio. It's essential to maintain diversification across different asset classes and investment styles to manage risk and achieve your overall financial goals. Question 12. Can the SPYI ETF be used for income investing or dividend growth strategies? The SPYI ETF possesses characteristics that align partially with both income investing and dividend growth strategies, but with certain caveats. For income investing. High dividend yield. The SPYI ETF boasts a higher current dividend yield compared to most traditional SP 500 ETFs. This can be attractive for investors seeking regular income streams to supplement their other income sources or fund ongoing expenses. However, consider these limitations. Sustainability. The high dividend yield might not be sustainable over the long term. Companies with high dividend yields may need to reduce or cut dividends in the future if their profitability declines. Volatility. High dividend pairs can be more susceptible to market downturns, potentially impacting both the share price and dividend payouts. This can lead to income volatility, contradicting the goal of stable income generation. For dividend growth strategies. Focus on dividend-paying companies. The SPYI ETF invests in companies with a history of paying dividends. This aligns with the core principle of dividend growth strategies, which focus on companies with a track record of increasing their dividend payouts over time. However, keep in mind these considerations. Lower long-term growth potential. The SPYI ETF primarily focuses on mature companies with established dividend histories. These companies might exhibit slower future growth compared to the broader market, potentially limiting the long-term growth potential desired in a dividend growth strategy. Active management fees. The expense ratio of 0.65%, as of February 27, 2024, reduces the overall return for investors, potentially eating into potential long-term dividend growth. Therefore, the SPYI ETF can be a conditional option for both income investing and dividend growth strategies. It offers some desirable features, but comes with limitations that might not align perfectly with the core objectives of each strategy. Question 13. What are some alternatives to the SPYI ETF? Here are some alternatives to the SPYI ETF, catering to various investor preferences here. Similar high-dividend ETFs here. Vanguard High-Dividend Yield ETF, VYM. This passively managed ETF tracks the FTSE High-Dividend Yield Index, offering exposure to high-dividend paying companies across various sectors. It typically has a lower expense ratio, 0.06%, compared to the SPYI ETF, but may also have a slightly lower dividend yield. SPDR SP Dividend ETF, SDY. This passively managed ETF tracks the SP High Yield Dividend Aristocrats Index, focusing on companies with a history of increasing dividends for at least 20 years. It offers a balance between income and stability, potentially appealing to risk-averse investors. iShares Core Dividend Growth ETF, DGRO. This passively managed ETF tracks the SP US Dividend Growers Select Index, focusing on companies with a history of increasing dividends for at least 5 years. It prioritizes long-term dividend growth potential over current yield, which may be suitable for investors seeking income in the future. Broader market exposure with dividends. Vanguard SP 500 ETF, VOO. This passively managed ETF offers exposure to the entire SP 500 index, including both high dividend and low dividend companies. While the dividend yield is lower than the SPYI ETF, it provides broader market diversification and potentially lower volatility. iShares Core MSCI World UCITS ETF, IWDA. This passively managed ETF provides exposure to large and mid-cap companies across developed markets worldwide. While the dividend yield may not be as high as the SPYI ETF, it offers global diversification and potential for long-term growth. Fixed income alternatives. Vanguard Short-Term Corporate Bond ETF, VCSH. This passively managed ETF invests in short-term investment-grade corporate bonds, offering a potentially lower risk alternative to the SPYI ETF while still generating regular income. SPDR Bloomberg Barclays 1 to 3 year US Treasury Bond ETF, SHY. This passively managed ETF invests in short-term US Treasury bonds, offering a low-risk alternative with guaranteed income from the government. Alright everyone, that's all the time we have for the SPYI ETF today. Remember, this isn't financial advice, and you should always do your own research before investing. But hopefully, this video has equipped you with a solid understanding of the SPYI ETF, its potential benefits and drawbacks, and how it might fit into your investment strategy. If you're interested in learning more about other high dividend options, broader market exposure, or even fixed income alternatives, be sure to check out the linked resources in the video description below. Don't forget to like this video, subscribe to the channel for more ETF discussions, and hit the notification bell so you never miss an upload. Thanks for joining the conversation on Chat ETF, and we'll see you next time.